5 finance topics every entrepreneur needs to know. Are you ready to learn the 5 key financial secrets that could make or break your business? It's important to know how much it really costs to run a business. How well do you understand that? This video will teach you the most important money topics that every business owner needs to know. Your company's success depends on it. Prepare to become even smarter about money. Let's jump right in. Number 5. The management of cash flow. Every firm relies on its cash flow to survive and thrive. The amount of money that comes into and leaves the firm is represented by it, and it is essential to correctly manage it in order to ensure that day-to-day operations are maintained. Rather than failing due to a lack of earnings, many new enterprises and small businesses fail because they are unable to generate sufficient cash flow. When it comes to understanding cash flow management, there is more to it than simply keeping track of revenue and expenses. Cash flow forecasting is essential for entrepreneurs because it allows them to anticipate future financial demands, manage accounts receivable and payable, and provide a buffer for expenses that may not have been anticipated. The process of creating forecasts of future cash inputs and expenditures in order to anticipate prospective shortfalls or surpluses is referred to as cash flow forecasting. Working capital management refers to the process of ensuring that the company has sufficient short-term assets to satisfy its short-term liabilities. The practice of maintaining sufficient liquid assets, cash, or assets that may be turned into cash in a short amount of time in order to pay immediate financial obligations is referred to as liquidity management. When it comes to maintaining a positive cash flow, entrepreneurs should prioritize maintaining a positive cash flow over profits. They should also routinely analyze their cash flow statements and change their spending based on cash flow forecasts. In order to do this, it may be necessary to negotiate more favorable payment terms with suppliers or to provide discounts to consumers who make early payments. Number 4. Understanding financial statements. Statements of financial status are the lenses through which one can gain an understanding of the current state of a company's financial situation. In addition to this, they provide vital information regarding the success of a firm, its current financial status, and its cash flow. Every entrepreneur needs to have a fundamental understanding of the 3 fundamental financial statements: the income statement, the balance sheet, and the cash flow statement. These 3 statements are the foundational financial statements. It's a financial record that displays the revenues, expenses, and earnings of a firm for a specific time period. The income statement, which is also known as the profit and loss statement, is another name for this document, providing a picture of the assets, liabilities, and equity of a firm at a certain point in time is the purpose of a balance sheet, which is a document that offers this picture. One type of financial statement is known as the funds flow statement, and its purpose is to track the movement of funds into and out of an existing business. Specifically, it provides information that is of great use concerning the operations, investments, and financing activities. Those who own businesses ought to make use of these statements in order to assess the financial performance of their organization, identify patterns, and arrive at judgments that are founded on reliable information. As an illustration, if the income statement discloses that profits are declining, this may prompt an investigation into whether or not the costs are increasing or whether or not sales are decreasing. The evaluation of financial statements on a regular basis is also important in making strategic decisions, such as expanding operations, cutting costs, or investing in new opportunities. This is where the review of financial statements comes in. Number 3. Cost management. To maintain profitability, it is essential to have efficient cost management, particularly in the early stages of a corporation when resources are limited. This is especially true in the early stages of a firm. When entrepreneurs have a strong understanding of the many different types of expenses, including fixed, variable, and semi-variable costs, they are better positioned to make educated decisions regarding pricing, budgeting, and scaling their firms. One thing that should be kept in mind is that fixed costs are expenses that do not alter regardless of the amount of output or sales that are being made. One example of a fixed cost is pay, which includes things like rent and wages. On the other hand, variable costs are costs that change in a manner that is directly proportionate to the amount of production or sales. For instance, the cost of raw materials or transportation are examples of variable costs. The break-even analysis is the process of establishing the point in time at which the total revenue of the firm is equal to the whole costs of the company. This indicates that the company is neither earning a profit or any loss at that particular point in time. Entrepreneurs should conduct a break-even analysis in order to establish the minimum quantity of sales required to cover their expenses. This is a crucial step in the process. It is possible to build price plans with the help of this information, and it may also be of assistance in deciding whether or not efforts to minimize costs are required. Furthermore, conducting regular assessments of cost structures can assist in identifying areas in which expenses can be reduced without compromising the quality of the product or the quality of the service the organization provides. Number 2. The funding and capital structure of the organization. Obtaining the appropriate kind of financing is absolutely crucial when it comes to starting a business and increasing it over time. For entrepreneurs, it is of the utmost importance to have a full awareness of the many financing options that are available to them. Equity financing, debt financing, and alternative funding sources, such as crowdsourcing, are all examples of these varieties of financing alternatives. The capital structure of the company, which refers to the combination of debt and equity that is utilized to finance the organization, is a crucial component that plays a role in defining the financial health of the company as well as its potential for expansion. Equity financing is a method of raising capital by selling shares of a firm. The word equity financing refers to this method of raising capital. A reduction in ownership may be the result of this sort of financing, but there is no requirement for repayment of the loan. One example of debt financing is the practice of borrowing money that must be repaid with interest to the borrower. Despite the fact that this kind of funding can be risky, it does enable the entrepreneur to maintain complete ownership of the company and its operations. Angel investors and venture capital are two types of equity financing options that entrepreneurs can utilize. These investors provide financial support in exchange for a share of ownership in the company, and they frequently play an active part in the development of enterprises. The owners of businesses should carefully analyze the pros and downsides of each potential source of funding in order to make an informed decision. This involves taking into consideration variables such as the cost of capital, the degree of control of the company, and the influence on cash flow. In addition, it is of the utmost importance to maintain a capital structure that is well balanced in order to reduce the potential for financial risk while simultaneously boosting the potential for growth potential. Number 1. Accounting for taxes and regulatory compliance. Taxation and regulatory compliance are one of the hardest parts of entrepreneurship. For fledgling enterprises, juggling tax duties and local, state, and federal requirements can be stressful. Understanding these criteria is essential for avoiding legal issues and protecting the business's finances. Tax and compliance concerns can result in serious financial fines and damage the company's reputation, making them crucial to corporate management. Tax obligations explained. The first step in tax and regulatory compliance is understanding the many taxes a firm must pay. These may include income, payroll, sales, and industry-specific taxes. To avoid costly mistakes, you must know the rules, regulations, and deadlines for each tax kind. Income tax, business earnings. To avoid fines, calculate and pay income tax correctly and on time. Businesses must deduct payroll taxes from employees' paychecks and send them to the government. Includes federal income, Social Security, and Medicare taxes. Sales tax may be collected from customers and paid to the state, depending on location and type of business. Businesses must comprehend local legislation because state rates and requirements vary. Each of these taxes demands careful preparation and organization to avoid large fines for missed deadlines or erroneous submissions. Businesses can decrease their tax burden by taking advantage of deductions, credits, and incentives with proper tax planning. The value of tax planning. Successful business management requires tax planning. It entails planning financial operations to reduce tax bills while complying with the law. Businesses can optimize their taxes with many strategies. Using deductions, office supplies, travel, and marketing can be deducted from a company's taxable revenue, lowering its tax liability. Credits and incentives. Governments offer tax credits or incentives for company actions like investing in renewable energy, hiring disadvantaged workers, or doing research and development. Income deferral. Income deferral is a typical way to lower current year taxes. This is especially helpful if the corporation intends to pay less tax in the future. A business can avoid overpaying taxes and comply with all rules by properly controlling these factors. Payroll compliance and management. Companies with employees must manage payroll for tax compliance. The proper tax authorities must receive precise payroll tax withholdings. Federal income tax, Social Security, Medicare, and sometimes state or municipal taxes are included. Inaccurate payroll calculations or late submissions can result in large fines or even personal liability for unpaid payroll taxes. In addition to tax requirements, firms must comply with labor rules including the FLSA, which oversees minimum wage, overtime, and employee classifications. Avoiding business-related legal concerns requires proper management of these duties. Compliance with regulations. Beyond taxes, firms must follow industry-specific laws and licenses. Compliance with government rules, norms, and guidelines is regulatory compliance. Different industries are regulated differently, and failing to comply can result in fines, legal action, or business closure. To achieve cleanliness and food handling standards, a restaurant must follow health and safety rules. However, financial reporting, anti-money laundering, and consumer protection requirements apply to financial services companies. Environmental legislation, data protection standards, GDPR or CCPA, and industry-specific licensing needs can also be met. Business owners must constantly evaluate industry regulations to maintain compliance, working with pros. Tax laws and regulations are complex, therefore business owners should work with accountants, tax experts, or lawyers. These specialists can help create a comprehensive tax strategy that meets the business's needs and follows all requirements. The business can reduce its tax burden by maximizing deductions, credits, and incentives with tax professionals.